Hello everyone, welcome to our session today. What we are going to do today is create a video series which will talk about investment basics for traders as well as long-term investors. We are going to cover topics all the way starting from short-term investments or tradings all the way to long-term investments for all investors. This is not only targeted to retail investors, but we are going to cover all aspects of our journey, which talks about investments, perceptions around investments, and risk management. Well, for today's session, we have with us an expert who has 17 plus years of experience in stock market investments and analytics associated to it. Let's get started. We welcome with us Mr. Shumoy Goswami, who is a well-versed person in this sector. Thank you, Shumoy, for your valuable time today and join us in this session. So my first question to you would be, if you can tell us a bit about your background and how did you end up into this profession, or how did you get an affinity to start with this, if you can share some words with our audience.
Sure, I would love to do that. And before that, thank you for having me in your show. Education wise, I am an engineer. I did my graduation in mechanical engineering and I did my also engineering job. But I was always fascinated with finance and the risk management and the stock markets things. And slowly, I did not know when the actual shift happened, but slowly I shifted and drifted to financial world. Now people believe that an engineer has nothing to do in financial market, but that is absolutely not the correct thing. I have seen many engineering graduates from IITs, rookies. Those top graded engineers are doing work in finance and they are doing excellent work. Job wise, initially I began my career as in a stockbroking firm. My job was to analyze the market, what could happen next, which sector could do better than other sectors, what could happen to the market, either it could go up or go down, what is likely ahead. Then what could be a good investment, keeping in view the current market situation or what the market situation could be like that. So I did it for almost 13 or 14 years, right? Then after that, I have progressed into some more specialized job of asset management. Right now, I am managing a portfolio in my current company, which is around 20 crore.
That brings us to the next question, which is, what is the formal definition of an investment process and what could be the objectives of the common people or traders or investors, retail investors, towards investment?
That's quite a nice question. And everybody do some investment, whether they are knowingly doing it or without knowingly doing it. You may be buying some gold or you may be buying some land, real estate, right? Everybody is into investment, but they do not know what they really want from their investment. What is their objective? They do not know. If you do not know what you are going to achieve, then you will never achieve that. The point of investment, everyone has their different objective, and this is not a one answer fits all type of question, right? But the basic objective is to beat the inflation. That is the basic objective. You know inflation because if we want to define inflation, it is as if that a lot of money is chasing so few goods. So by the supply and demand equation, the prices of goods will go up. That's basic thing of inflation. Now, inflation is reality, and in our economy like India, slight inflation is also good. Now, if we have rupees 100 in our pocket and we are keeping it in our pocket forever, that money is going to lose value over next year. It will buy you goods only worth rupees 95. Next year, it will buy you goods only rupees 89. Like this way, value is going to be depreciated. So the first objective of investment is to beat that inflation, right? So if your 100 rupee becomes 105 or 106, then at least you are at par with inflation. So that is the first objective. After that, you want to have some return, right? So this particular return will depend upon what kind of risk you are going to take, right? Some people have their own objective that I want to invest for my retirement, right? I want to invest for my son's education, daughter's marriage. All these things are coming, and accordingly they will have to take risks, right? So everyone have their own agenda or own objective of investment, but the basic objective must be to beat the inflation. That's it.
So when we talk about investments or stock market by and large, we see mostly people losing money. Mostly. By and large, we see people making money to a very smaller extent. Like we see a fraction of the participants, like people, shark investors or big people who really have a good portfolio, who have a chunk of, you can say, amount invested. Even they make losses, but yeah, they have a mechanism to recover that. But retail investors, be it the common people or people who in an average every day they get into the stock markets, we often hear, or mostly we hear, people losing money. So that brings me to the next question. Is stock market really gambling, or investment really gambling? How would you look at it?
Forget about the market. Forget about the market. In real life, I have heard Mr. Mukesh Ambani to say that he does not know where crude price is going. Okay, so nobody knows what is going to happen next in any industry. But that is a separate thing. First, we need to understand what is gambling, and then we can only understand whether investment process is really akin to gambling. What is gambling? Gambling is to indulge in something, taking some risk where the odds are not in your favor. And if you still want to do that, then that is gambling, right? But if something you know and you want to take your small risk there and odds are in your favor in this case, that is not gambling. Okay, say there are casinos in USA. There are casinos, and a lot of people go there and they lose money and they come out almost broke every time, right? But they believe that one day they will come winner. What is the thing? That casino, there is a roulette game. Suppose I am giving you an example of game of roulette. A ball moves, right? And there are some numbers. Some numbers belong to the house and some numbers belong to the player. Now the ball, whichever square it captures, if it belongs to the player gets the money, or if it does not, the house gets the money. Now suppose there are 100 squares, 51 squares belong to the house and 49 squares belong to the player. So there is a slender 2% edge of the house, and that slender 2% edge plays out itself over and over again, so that in net, over a long period of time, the house gets the money and the money is transferred from the player to the house. So in this case, the players are the gamblers, but the house is not the gamblers. Okay, house has an edge in its business model. Every business model has an edge, and the house has created its edge like that. And in order to entice the people to keep coming, keep losing money, they offer what? Free alcohol. Okay, okay, and for the free alcohol, people keep coming and they keep losing money. So that's their business model. They have to earn it because they are answerable to their investors. So this is what is gambling. If you do something in which field you have no expertise, that is gambling. The same thing is applicable to stock market. If you do not know what is your worst possible scenario in a particular investment and you keep adding money to that and you keep giving money to that particular investment, suppose that you have done a bad investment. Say for example, you have done a bad investment. The value of your investment is keeping coming down. Now at one point of time, you have to accept yourself. You have to accept that it is a mistake. Later on, I will say it is not even a mistake, it is just the process. But say for example, you are understanding it is a mistake, and at that point you have to accept the mistake and keep out of that position, keep out of that investment. If you do not do that, and if you try to find some logic or create some logic to yourself that okay, this news is good for the stock, or that news is going to happen, this or you are taking opinion of other people's, you are not listening to the negative news, you are only listening to the good news of that stock, and you are trying to justify your earlier decision. Now that is what is gambling you are doing to your money. And most people I'm telling you why most people lose money, and it is true that almost 98% people lose money, only 2% people earn money, because they have mastered themselves this particular conception that I'll be wrong in many cases. But if I can understand, accept my incorrect movements, I will take a small loss and come out. Then I will take another small risk somewhere else, and that may be a winner, or that may even be a loser. But if that is again a loser, I will take my third trade, I will take my fourth trade. So if I really have a good strategy which plays itself good, like the casino model, right? So it will play itself out over a long period of time. So that is not gambling. Okay, so that is real business model that investors have to execute for themselves. So my answer to this question is everything we do is a gambling if you do not understand the risk. I can give you one more example. Suppose we are at one point of time, we are thinking, should I go for science? Should I learn science, or should I learn commerce, or should I learn arts? So this could be a gamble for yourself, right? You do not know, should I marry this girl or should I marry that girl? This is also a gambling that you are going to take at one point of in your life. So every decision you take is a gambling if you do not know the actual risk involved. But if you know the risk, then it is a calculated risk. It is not a gamble. And you can play stock market like a gamble. You can play stock market like a business. It is up to you. So that's it.
Wow, that's an amazing explanation or amazing outlook at the entire market. So now, since you mentioned a couple of times the word risk, and you said that big investors are also quite aware of their risks in the decisions involved, like they're aware of what can possibly go wrong in an investment if they end up losing that money. So they enter a decision, or an investing decision rather, if we put it that way, knowing that what can go worse in their decision if they end up losing all of that money. Well, risk or uncertainty in such a scenario or investing world is always treated as a jinx or something which has a catastrophic outcome. That's what we have seen by and large people getting at the back of their mind, including me. So is risk always something indicative of something bad or something worse of a decision or a nightmare that is going to bring onto the lives of the people? Or risk also has something better waiting at the other end of it? Like, I'm talking about a radical lens of the word risk or uncertainty. One side of it is absolutely going to be a catastrophic decision if they end up losing all the money. What could be the other side of this word risk?
This question encompasses the entire concept of stock market or risk management, anything. One thing I must tell you, that no investor should wait till his entire capital is wiped out. No, that is not the thing. That is not risk, right? The correct approach is to find your edge, slight edge. That means you have to find by your analysis or statistical approach in the market that if something happens, something else is more likely to happen. If A happens, then B is likely to happen. Or if A happens, then C is likely to happen, right? But that does not mean that always it will happen. Sometimes it will not happen as well. So if you can understand that, you have some technical parameters to define whether A has happened or not. So if A has happened, then you will taking your risk. You are taking your risk. You are dividing your capital into a lot of segments, diversifying your position and taking small risk with each and every position. And some of them will play in your favor, some others will not play in your favor. You will lose some money in the positions where you are wrong, right? And you are making money in positions where you are right. So your job as a risk manager is to cut the losses early and let the profits run. This is difficult for common people. Now this is where most people falter, and this is where people end up losing almost all their money. They close their profitable positions early and they keep their bad positions open for a long period of time in hope that they will come back. That does not happen. That is equivalent to, you can say that is equivalent to a miracle, right? And miracles may happen somewhere else, but not in investment and stock market. Miracles do not happen. So you have to take your risk and you have to manage your risk. You have to cut your losses short and you have to take your profits long. You have to hold your profits. Now people are afraid of losses, but I can tell you people are more afraid of profits. Okay, because they cannot withstand the profit. They are believing that tomorrow my market may fall and all my profits may be gone. Right? So that is the wrong thing to do. First of all, we have to get the perception right. You are defining your risk and you are taking many small calculated risks. That is all about stock market. Let me put it this way. There was a very famous trader and he was interviewed and he was asked that, sir, why are you in the stock market? Why you could have done anything else, right? You are so successful in stock market, you have learned so many millions of dollars, but why you came to the stock market? His response was that, see, I have made lot of mistakes in my life. I did not go to college, I could not complete my education, I married a wrong girl, I am divorced, my sons and daughters do not listen to my words. My life is like a hell. I understand that I have taken a lot of bad decisions, and that is why I am in stock market, because stock market is the only place where you can make lot of bad decisions and still you can end up making money, provided you understand that you have made a bad decision, you are cutting your losses early. So stock market is not a place to gamble. Stock market is a place to do some serious business, provided you understand the risk, and market is there to give you profit, but your job is to make the cut the losses, right? That's all.
Thank you so much for giving us such beautiful insights and such deep insights around how we can actually make more informed decisions in our lives. But here comes the question, which is it really possible to make up from considerable losses in the stock market to get something more profitable for your portfolio? If somebody has made a loss in the first place, or as a retail investor, if I decide to enter today, or somebody decides to enter today the stock markets, is it really possible for them to reap some benefits from the stock market? And would you like to tell us your views on what are some of the common mistakes that investors can avoid? Be it a trader, be it a retail investor, what do you think are some of the common mistakes that people hold on to as a dogma or as a decision that they don't want to move away from? What are the things that you think are important in this place?
Nice question. You want me to tell the truth or the lie first?
Okay. Let's go with the lie first.
Lie first. Is that, yes, the stock market is there and it is for you to make money. So come and buy this stock. This stock we have a good tips on this stock. So this stock is going to be higher now. So buy and earn your money. So that's
Okay. Thank you so much. And now let's get to the truth.
Yeah, the truth is that it is actually one of the most difficult places to earn money. Why I am saying this is that when you are a trader or you are an investor, the society as a whole does not want you to be successful. This may look shocking, but let me tell you this way. Whenever you are making some investment, the government is there to tax on your investment. The broker is there to take their brokerage. The depositories are there to take their fees, right? They do not care whether you are making a profit or loss. They just take their portions of their shares, right? What is the difference between being a trader and being a doctor, right? A society cannot afford a doctor or an engineer to fail in his profession. The society cannot afford, because if a doctor fails, people will die. If an engineer fails, bridges will collapse, buildings will collapse. But if a trader fails, the society will be benefited. Why? Because his money will go to the government. His money will go to the depositories and brokers, and they are dependent on your money. You see? So that is why they will not teach you from your childhood how to manage risk, how to face uncertainty. This is a problem with our education system, right? In our education system, we are taught this is the right thing to do, this is the wrong thing to do. But in between the right and wrong, there is a huge sea of probabilities that we have to understand. When we grow up, we come to know that there is nothing called absolutely truth or absolutely false. Every good thing has a bad thing, every bad thing has some good things. We just have to take the calculated risk and take our decision accordingly. Stock market is difficult from another aspect as well, that you have to accept that you do not know what is going to happen next, and that is very difficult thing for some people, those are really successful in their own profession, to accept. Okay, because many wealthy people come to stock market from all their egos or from their own field. I am a successful doctor, I am a successful entrepreneur, I have done very good in my own profession, so why can I not do good in stock market? Right? Just tell me what the stock market is going to do. Just tell me whether it is going to rise or whether it is going to fall. Right? They just want this insight. Now, the one person who is being asked, he fully knows that he does not know, but he cannot say that. Right? He has to sound very smart. Otherwise, maybe he is an employed person, or maybe he is paid for his views, so he will not be paid. Right? So he will give a lot of answers like, yes, this may happen, and at the end he will find that he does not know. Okay, if this happens, then market will go down, if this happens, market will go down. So first of all, you have to accept that you have to operate understanding that there is no certainty that the market will rise or fall tomorrow. Right? But you have to know this, and this is what is most important. You have to know this, that the market, if it goes higher, what you should do? You should know that. If you know that, then you are doing good. If the market falls tomorrow or day after tomorrow or next week, then what you have to do? If you know that, probably you will have to cut your losses in that case. There is no other way, right? And wait for the market to turn higher. If you know that and you actually can do that, because taking the losses will take a lot of courage. Not many people can do that, right? You have to accept your mistakes, and not very many people can accept their mistakes because they have a lot of ego. They have brought those egos from their own field of expertise, right? So they cannot do that, and that is why it is one of the very difficult thing to do. Now, rest is very open to you. The stock market is there. Stock market in India has given almost 11% return, compounded growth from 1995 till 2023. So if there is a certain asset that has given you 11% compounded growth without having to do you anything, just buy and hold, buy and forget, why can you not earn some money to beat the inflation, where the inflation is 7% and there is an 11% return asset that is in front of you? Why can you not? The problem is that there will be lots of ups and downs, and these ups and downs will define the risk. If you can manage the risk, yes, you can earn money in the long run from the stock market.
So basically what you are saying is not to be a tuning fork, not to resonate with the vibrations that the external factors are imposing on you or bestowing upon your thought process, and react very erratically or irrationally according to that. So behaving like, okay, you got a good news, you invested, you poured all your capital, you took huge loans, you poured in all your life savings into that, and whenever you see a bad news, you took it all out and you're just sitting on huge pile of cash. So if you are saying that if somebody just keeps a calm demeanor, he can be successful in the longer run, is that what we can?
Absolutely. But two things I have to tell you here is that please do not borrow money and invest it in your market. So you can invest only with the money that you can afford to lose. Okay, so do not borrow money. Already making money in the stock market is difficult, but if you are borrowing money, then that will be an added pressure, and that added pressure will work against you psychologically. It will not let you cut the losses. Okay, so that is first thing to do. Also, I may tell you that one should never work on news, because that is not a credible system. News cannot be quantified, and you are the recipient of the news at the last stage. You are the last recipient of the news. When something happens in industry that is not public as yet, the insiders already know that. If a company has some good numbers to present to the public, then the directors firstly know that. Okay, then from that directors there is a filtration of news to the lower channels, right? And after many levels, the news is got public. So when public actually gets the news, the insiders have already taken position, right? So that is why there is a saying in the market that buy on rumors and sell on news, because a company might be going higher in rumors, but when the actual news has come out, the insiders now are going out of the market. Insiders now are going out of the stocks. They are selling. So there is no point in buying that stock, right? So please never work on the news. That is not a credible thing to do.
Well, thank you so much for spending your valuable time and insights providing all of us. And for our viewers, this is just a part 1 of the series. We are going to cover many such sessions in the upcoming series and videos, covering from psychology of investing to analytics and what you can do, how to read stocks, how to read the trends, how to analyze the historical data and go about investing. And also there is one more important topic that comes to my mind, and we are going to make a video on that, which is how an average person can beat the mutual fund managers, or at least the thought process that they bring onto the table. Please stay tuned to our channel, subscribe and follow for more, and we'll see you again. Thank you so much.